Vikas Pershad, Portfolio Manager at M&G Investments. And Vikas, always good having you. Thank you so much for taking the time out and being with us. Can I start off with the micro, though, in the news somewhat, Vikas, with you, and ask you, do you look at the primary markets in India? Because they have been raging hot currently.
Always a pleasure to be back, and I'm glad we're starting here. I do want to start off by saying that I do not think that this is the dumbest market in the world for IPOs. I think the sample size is very large. When you have 1,000 IPOs over 4 years, of course, many IPOs are going to be mispriced. Many IPOs will do poorly. Some will do very, very well, but that's our job. That's the retail investor's job on where to allocate capital. But I do think that this is a fascinating market when it comes to new listings. It's very understandable why there have been so many and why we should continue to expect many listings over the next few years. I mentioned the 1,000 IPO number. We had just over 100 IPOs in 2022, 223, 324. It looks like we're on pace to match or exceed the pace from calendar 24. So that in aggregate, about 1,000 IPOs over 4 years. We've invested in about 1% of them, about a dozen or so, out of that 1,000-ish number. Now, most of those IPOs are very small, but now we're looking at an overall market in India with nearly 7,000 listed companies and nearly 2,000 with a market cap over 100 million US dollars. Now, again, I use that, it's a bit arbitrary. There's nothing special about $100 million, but when you exceed $100 million market cap, $200 million market cap, that is when the liquidity starts to improve, and that's also when you start to find the long-term compounding stories.
Understandably. Okay. Now, Vikas, the question that I would have is that what to do with some of these businesses which by definition are pointing towards the long term and in the short term are either burning capital for getting business or getting customers or getting subscribers, what have you. And you know, the bull will argue that forget from the bottom, but even if you bought into Eternal on the listing day at 154, 155 or what have you, 4 years out of post-listing, like 4 years out as well, if you are at 350, 370, you've more than doubled your money, and that's not bad returns. Yes, relative to equity market returns in some of the fancy stocks, it might be bad, but these stocks have made money. So is it a blanket avoid some of these highly punchily priced either listed stocks or newly coming IPOs which have a long gestation business nature?
No, I don't think anything is a blanket avoid. Everything merits time. Some opportunities merit more time, some merit less. The question that you have to ask yourself is really, what do you want to achieve? If you're looking for a day one pop, that is a very risky game. There's a lot of arbitrariness involved in that. But if you have a genuine long-term time horizon, if you are an investor, and if you are willing to size positions appropriately, knowing that there's a chance that something might not trade very well out of the gate, you can start a position and you can add on pullbacks if you've done your work and you have conviction for the long term. That is our approach. That works for us over long investment cycles. And I think that's a sensible approach to take. When we invest in an IPO, we're not looking for a material gain on day one or in the first month or even the first quarter. It's nice when it happens, but when we do a lot of work up front, which is why we invest in so few companies, and the hurdle is even higher for us to allocate capital to a new listing. But we have a multi-year time horizon. And as you pointed out, on a multi-year time horizon, many of these listings do well. But you do need to compare, you do need to take into account compounding. If something has doubled, but it's taken 6-7 years to double from your IPO price, then you have to question, well, is the return on passive money not better? Is the return on an index overall not better than that? So it just highlights the importance of doing your own homework. It reinforces the fact that India is a great market for active management, not just for passive management.
That's true. Now, you know, and lest this sound like an IPO conversation, it is not, but I'm still inclined to ask you one more question, Vikas, and which is that much as the larger names are these tech-related names, and you can argue a Lenskart or a Grow, etc., are all tech-focused businesses with underlyings being different, but let's call them tech for whatever reason, right? All tech-enabled businesses. But there are a clutch of other non-tech old economy companies which have come in, which have gotten subscribed heavily and have delivered decent performances on listing. I mean, from a Studs helmet, which got subscribed 73 times. We don't know how it lists, but it got subscribed 73 times, to a Regal Resources, to another company which is into rare earth as well and mining as well. There are a lot of other businesses that have come up as well. Have you been subscribing to the tech-enabled and tech-focused names, or are you looking across the bucket even in the newer companies?
This is the right question, because in India broadly this year, if you look at the equity market performance relative to North Asia and the US, why has India underperformed? Because it's been seen as the anti-AI trade. Our view is different, is that if you're a long-term investor and you're willing to do the homework, every sector you can imagine today, but for the exception of the semiconductor hardware sector, is available to you in India. If I look at the dozen or so IPOs going back to just the period just coming out of COVID, for us, we've invested in hospitals, auto parts companies, travel companies, yes, one or two consumer-led or tech-led consumer platforms, but really tech-enabled businesses haven't driven our IPO returns. They've not been the prominent theme in the companies that we've invested in. Manufacturing, defense, this is what has been featured in our IPO investments, and they've done so far better than our expectations. So you mentioned that they've done decently. I would say that many of them have done better than decently, and we presume that that will continue to be the case.
Okay, fair call. Now, Vikas, what's your view on India because of two things, right? There is a flurry of trade stress thawing that is happening. Maybe with India, it will happen at some point of time, India and the US. Maybe it happens, maybe it doesn't, we don't know. But with the presumption or a hypothesis that it turns the corner at some point of time. And this whole AI bandwagon starts spreading out a little bit to some of the other buckets as well. Thus far it hasn't, but I think there are notes out there which are saying that at some point of time this AI bubble will cool off a little bit and people will start looking at the non-AI trades as well. And therefore India then stands at that intersection of both of these patterns for a market which has not performed as well as some of its peers in the last 15 months and therefore stands a chance to gain in 2026. Is that a reasonable argument?
I think so. That's our view, that the setup for India looks good for calendar 26. We still have 2 months to go, almost 2 months in 26, so we're not spending too much time yet thinking about next year. However, the setup, given the long-term story, is still intact, is our base case view. The setup for India is good. We also should remember that over the last 15 months, India might have underperformed, but for the last 2 decades, alongside the US, in dollar terms, not just in local currency terms, but in dollar terms, this has been the best foreign market in the world. It's been the most active market for new listings. It's been a long-term compounding story. Nothing has changed about the long-term story for India, Indian economic growth, Indian entrepreneurship, in our view. So we're very excited about India on a long-term view. The entrepreneurs that we're speaking with, they're leading businesses that are focused on profitable growth, not just not just revenue, agglomeration. They have clean balance sheets. So we're seeing a lot of opportunities that we like, especially in this period where relative to other markets, India's underperformed. You mentioned the potential thawing of trade headlines, or the trade freeze on India. India was the first major market in the world to erase the post-Liberation Day losses in early April for good reason. If you see in mid-August, when the latest tariff headlines peaked, that also marked an inflection point for the market, and we've been steadily grinding higher since then. So we remain constructive on India. There's a lot to like for a genuine long-term investor. The shorter the time horizon, the trickier things get. But that is how we get around the noise, is by playing time horizon arbitrage and focusing on the long term. And there's a lot that we like.
3 sell-side notes today, all of them saying that earnings momentum likely to now happen in Q3 because Q2 has not been as bad. What is your thesis? Are earnings the necessary and the sufficient condition?
But this is our foundational view, that stocks follow earnings, markets follow earnings. If you look at the Indian market performance over the last 20 years, why has it done so well? Why is our view that the market is pricey but not expensive? The view being that if something is pricey, you're getting something in return. In India, you get the highest ROEs in the world, especially if you adjust for cost of capital compared to other emerging markets. You're getting the highest earnings CAGRs in the world. And so you're getting something in return. That remains the case now. And so we think that there's plenty of opportunity available on offer, and stocks will follow earnings. If you look at some of the defense names, some of the consumer names, some of the hospital, healthcare names, auto parts names, autos. What is also very exciting is, yet again, we've been reminded in this earnings season that there's value to doing your homework, to being selective, because there's a lot of dispersion in earnings outcomes and in stock price performances. Pick any sector, and you will see that dispersion. So there's value for putting in the effort and doing your own work and then coming up with your own views, rather than investing in a more passive fashion.
Last question, Vikas. The earnings growth, Q1 and Q2 both, have been driven to an extent by some commodity-linked names as well. Cement for both of the quarters, metals thus far in Q2. Are these good plays, or would you rather bet on other things in India?
We are exposed to these sectors. We're not heavily exposed to these sectors. But these days, everything is touched by commodity prices, public policy, and demographics, some combination of those three areas. So I would say there's plenty on offer in India. If you look at our 10 largest overweights, 10 different sectors, from private banks to hospitals to consumer tech platforms to auto parts companies, it's a very diverse market, which is why our portfolio is also diverse. I would say it's also a very pan-India portfolio. These companies are not, portfolio is not like it used to be 20 years ago or even 10 years ago, concentrated in companies listed in Bombay, Bangalore, and Delhi. We have a very nationwide portfolio, which is very exciting. And I'm looking forward to years of investing in this market.
Got it. Okay, Vikas, so good talking to you. Thank you so much for taking the time out and being with us today on India Market Open. Really appreciate your time.
My pleasure. See you next time.
Yep, see you next time soon.